This is Brian Castle with the FourStar commentary for June. After the first quarter numbers and our last monthly commentary coming through as basically flat in the U.S. economy, then the next couple of months, if we're seeing a recovery, should show some better numbers. We're seeing a little bit of that, not a lot of that. Home starts declined 3.3% in May, but the numbers in the previous month were huge and very positive. So again, here's the backing, the filling we talked about. Home prices are appearing to be going back to a record level. Durable goods dropped 0.5% in April. That's a negative. Business investment rose, on the other hand. Shipments of core capital goods rose 0.8%. That's a very positive number. The employment index, seasonally adjusted, 0.7 versus 0.5 expectation, so that's obviously a positive as well. At the same time, jobless claims in late May were coming through a little bit higher than expected. That's not a positive. And on the other hand, layoffs are at record lows from corporations, not laying people off and holding on to their employees. So we're seeing growth, but we're seeing it in backing and filling and backing and filling, and that's been the nature of the economy for a while. That's, however, in contrast to things that we're seeing in other parts of the world. Because of all the adventures in Russia, militarily, the Russian economy is struggling. The 1 month negative number in retail sales was down 9.8%, so clearly Russians are concerned and they're not spending. They're not spending their money, they're hoarding capital, and so that's a really negative number. The Financial Times reports their view, along with the views of the Wall Street Journal and the other economic writers in the U.S., that we're well positioned for growth. The U.S. economy, although it's growing slowly, is still the leading growth economy in the world compared to many other economies that are not growing pretty much at all. Some are in a state of recession. So we're seeing record job openings and vacancies in the job market that need to be filled. We'll see how they get filled. But generally, I still think we are recovering in the economy, even though we had a bad first quarter due to the weather issues and then the labor strife at the West Coast ports. So the Federal Reserve is still on track to raise interest rates. Some are saying as early as June, and some are saying not until next year. But probably there will be one increase in interest rates when the Federal Reserve feels that enough of the economic numbers that they need internally are looking positive. But they'll probably raise rates and then just wait for a while. There will be no rush to move rates significantly higher that could choke off whatever growth in the economy that we have. But they're in a position of trying to normalize interest rates. Normalize would mean something other than zero, which is where we've been since the fall of 2008. So we're trying to get interest rates back up to a normal economic level, and then they'll float essentially in line with what the economy is doing. On the other hand, talking about the markets, we continue to see the stock markets near new highs. The international stock markets are much stronger than ours this year. I mentioned in last month's commentary that would signal that an economic recovery is happening in the European markets and some of the Asian markets as well, but most importantly Europe. So if the markets continue to show that action, that's the action they show usually 6 to 12 months ahead of an economic recovery. The market tends to be a discounting mechanism and tends to lead the economic recovery. That's what we're seeing. If it's a false move, it's an incorrect signal, then the markets will fade and not grow as fast. But this is the kind of action we see before economic recovery that we think could be happening in Europe. Most of our portfolios are ahead of the market. The U.S. markets are anywhere from 2 to 4% of positive for the year. It's not right at the high, but it's near the high. What's really making a difference this year is international stocks. Our dynamic portfolios contain half of their portfolio in international names. So that portfolio is doing significantly better as international markets are up 7, 8, and 11% depending on what index that you look at. Commodity prices have still been difficult, although in the tug of war, the tally score between different asset classes, commodities started to grow for the first time in a number of years in the recent tally score that we did in our weekly review. U.S. stocks are no longer showing the relative growth. International stocks and commodities are acting a little bit better. We'll see if that is just a mini bump or if it's a trend. Anyway, that's our report for this month. Not much new. We'll wait to see what the economy does going forward, and we'll talk to you next month.